7 banks are processing real transactions on Quant's orchestration layer. Not a pilot, not a testnet. Today. And the token sits around $58 below every moving average on the weekly chart. That gap is the whole video. Most people say a disconnect like that always closes. I think one question decides whether it closes upward or grinds sideways another year, and almost nobody's asking it. Let me show you what I found and what I'm doing about it. Here's where we are. Quant has sat in roughly the same price neighborhood since 2022, while the rest of the market ran 2 full cycles. Sentiment's flat. Holders are quiet. That's usually when I start paying attention because quiet charts on loud fundamentals are where asymmetry hides. But quiet can also mean dead money, and I won't pretend otherwise. So I went through primary sources this week. Quant's own material, the Bank of England's lab, the on-chain data. It changed how I'm sizing this. Let's start under the hood because the chart makes more sense once you know what it's pricing. Start with the problem Quant claims to solve. Every bank and fintech is building its own chain, issuing its own tokens. Connect that with one-off bridges and you rebuild the mess tokenization was meant to fix. Liquidity in silos. Every connection its own point of failure. Quant's answer is a layer called Fusion, and their framing is sharp. Core infrastructure can't be controlled by a single institution. That's the whole competitive position. They're not competing on speed. They're competing with bank consortiums, selling neutrality. Underneath sits QuantNet, their post-trade piece, the plumbing that runs after a trade is agreed. Least glamorous corner of finance, and the stickiest. Once you're embedded, you don't get ripped out. Here's the mechanism, and beginners should get this one. A tokenized deposit is commercial bank money on a ledger. It's legally tied to the bank that issued it, so it can't travel elsewhere. So the sending bank burns its tokens, and the receiving bank mints an equal amount on its own ledger. The value crosses. The token never moves. What's missing is a shared way for 2 separate systems to agree on what just happened. That gap is what Quant sells into. Now stack the proof. The Bank of England's synchronization lab is testing conditional settlement, where parts of a transaction settle together or not at all. Quant's inside it with a named treasury rebalancing use case. That's central bank money, not stablecoins. Separately, Quant joined the X402 Foundation, hosted by the Linux Foundation, around a payment standard for machine-to-machine transactions. AI agents paying each other with no human clicking approve, on a status code reserved decades ago and never switched on. Then the one nobody looked at. Quant's chief executive is hiring a chief information security officer. London-based, globally responsible, financial services background, client-facing. You post that role when you're about to sit through bank security due diligence at scale. That's a procurement pipeline showing months before any press release. And the man making that hire founded the standards committee governing blockchain. It all converges in September. Quant's own words. 7 banks, 1 shared orchestration layer, processing real transactions today. They present at Sibos in Miami on the 28th of September and the 1st of October. For years, the bear case was one word: pilots. That word just stopped applying. 2 cautions. Quant gets grouped onto standards lists beside XRP, Stellar, Hedera, and IOTA. That's a badge, not a moat, and it means Quant sells off with that basket regardless. And those slides saying Overledger will be compatible with Swift and Ripple's rails? Will be. Roadmap, not receipt. Here's what I can't resolve. Across all my research, not one source explains how any of this creates demand for the token itself. Banks license software in pounds and dollars. So the question is not whether Quant wins contracts. It's whether the token is plugged into the business at all. Hold that, because the chart's been answering it. Zoom out to the weekly time frame. On the daily, this is noise. On the weekly, it's structure. Price is recently trading around $55 to $60, below the 10, 21, 55, and 100 exponential moving averages, and below the 200 simple moving average too. A moving average is just average price over a window. Under all of them means every recent buyer is offside. Not fatal, but pain above your head becomes selling on the way up. The structure is a symmetrical triangle. Price is coiled between a falling ceiling and a rising floor since the 2022 lows. On screen, the lower band is green, the upper red, and price sits inside that green accumulation band. The pattern is years old, so it either resolves soon or stops being a pattern. For Fibonacci, I anchored from $62 in March up to 85 at the May top. That puts the 0618 near 68 and the 1618 extension at 53. 53 is my closest support. 62 is resistance now because it was support before it broke. Lost support becomes resistance. Underneath price is a Fibonacci relative strength index, which smooths momentum. It's oversold, still pointing down, in the zone this chart has bounced from before. I've drawn a falling white line across its peaks. Momentum breaking that line usually front-runs price by a candle or two. There's a matching line on price, capping it since the May top. So, my strategy. Load zone is $53 to $62. The conservative version waits for the white trend line to break. Invalidation is a weekly close below 49. Not a wick, a close. Targets are 80, then 100, then 130, and I trail behind them. First target hits, stop moves to entry. Second hits, stop moves to the first. If the weekly closes under 49, which likely means Bitcoin lost 60,000 and its own 200-week average, I'm not dumping my core bag. I would open a small hedge instead, 1 or 2x leverage, entered after 2-hour momentum goes overbought, targeting 41, then 31. Hedging, not panicking. My own book, since it's fair to ask. Held since the 2024 lows, took profits late that year, kept a portion, reloaded at 70 in early 2025, documented here. That reload is underwater, and ignoring that would be dishonest. There's a yield angle too. Only 2 meaningful liquidity pools exist here, one paired with USDC, one with Ethereum, showing 10% and 16% annually. Where they're useful is range execution. Pairing with USDC, the band below spot accumulates for you. The band above sells into strength. One last read that shaped my patience. The liquidation map shows leveraged longs below price already flushed out, while shorts stack from 62 through the low 70s, heaviest near $67 and $70. Thin fuel below, dense fuel above. Not a prediction, just where the pressure sits. Put both halves together. Fundamentally, this is the strongest institutional position Quant's ever held, with a dated catalyst in September. Technically, it's the weakest structure in over a year. Not a contradiction. That's what accumulation looks like while it's happening. Best case, Sibos delivers production numbers, the trend line breaks, momentum flips, and the short positioning above 62 becomes fuel. Worst case, the news lands, the token doesn't move, and we learn something painful. That it's decoupled from the business. What changes my thesis? 2 things. Neither is price. If Quant discloses a model where the token is required for access, licensing, or settlement, my sizing goes up meaningfully. If September comes and goes with real adoption and no reaction, this stops being an investment and becomes purely a range trade. So 3 things. Quant moved from pilots to live production, 7 banks, with a date on the calendar. The chart is oversold, inside its accumulation band, with $49 as the line that ends the argument. And nobody's answered whether the token participates in any of it. Here's what 2 cycles of holding taught me. Adoption and price are not the same trade. You can be completely right about the technology and still be early by years, and the only protection is position sizing and a stop you respect. If this was useful, please hit like and subscribe. It helps me a lot. And if you want the execution side, that's the Pro Capital Vault. My private Discord, with real-time portfolio tracking, the exact zones I'm working, weekly live strategy calls and prep reports, and direct access to me. Everything here is the thesis. In there you get the fills. Join button below, link in the pinned comment, or scan the code on screen. Once you're in, sync your YouTube account to Discord, and every private channel unlocks. Tell me in the comments. If Sibos delivers and the token still doesn't move, does that change your thesis? Or is that just how infrastructure works? Haven't seen my last breakdown? Watch that next. Same market, different angle. None of this is financial advice. It's my money, my plan, my invalidation. Do your own work before copying anyone's.